Bianco Town gets back to zero about 3 p.m. today.
Well, hunkered in his office right now, trying not to go out, is Jim Bianco, who we're so pleased is willing to join us, president of Bianco Research, who's had some stunning calls over this year, has really been a breath of fresh air in his real reassessment of free money and the lack of it. Jim, really, I want to start on one of the big questions ending this year, which is the discrepancy between bond markets and their expectations of what the Fed is going to do and what the Fed is saying they are going to do, which is raise rates a lot more than the market is certainly allowing for. Can you end the year helping us to understand who is right?
Well, historically, usually the market has been right. But in 2022, it's been the Fed. The market has been dragged screaming and kicking to the belief that rates are going to go up. And while both the market and the Fed are saying, you know, the terminal rate where they're going to peak is around 5%, the market thinks they're going to start cutting rates this year, where the Fed has made it pretty much clear that they're not going to be cutting rates this year. And that discrepancy is going to pretty much, I think, drive, you know, investing in the first half of 23. Are we going to get the pivot in 2023, or are we going to get the pivot in 2024? If the market doesn't get the pivot, which it is expecting, I think there's going to be some room for disappointment.
I guess that there's another way of asking this, which is, have we really gotten out of the woods with respect to some sort of more substantial financial disruption, or have we seen the bulk of it in terms of the rate move and the realization that we are in a new higher rate era?
I think we've seen the bulk of the move. Yes, there's still more rate hikes to come. There could be as much as 75 basis points more between now and, say, the spring. But yeah, I also think that whether or not we are in an era of higher rates, that's really the question. The market is still of some belief that in the next 2 years or so, inflation will settle back down to 2%, and interest rates can go back down, you know, somewhere around 2% as well. And it can approximate something that we saw pre-pandemic, where I'm more of the camp that we're in a higher rate environment now, that really, when the Fed starts cutting, you'll get to 3.5, and that'll be pretty much it. That's what easing will be, or maybe 3, which is what easing will be in the future. And then in the next flare-up, rates will go higher from there.
You know, Jim Bianco, you've seen big shifts. Like, let's look at the Chicago Cubs, Landon Dansby, Cody Bellinger coming in. I mean, big shifts for the Cubs going into next year. The big shift in our world, as Lisa alluded to, is money now costs something. We have a risk-free rate. We have a legitimate Sharpe ratio. Explain to the Ute how things change.
Well, I think the big thing with that is that in 2022, we saw that the total return in bonds, you know, how much money you lost plus the income you got. Remember, you started the year with no income. You started the year with pretty much a zero interest rate. Has been a record. We've not seen Bank of America saying it's been 104 years since we've seen these kind of losses in the bond market. And you're right. I mean, I'm a little bit surprised, too, that if you told me in January the worst market in 104 years, I would have thought that we would have had a lot more financial disruption than we've had so far. Maybe that's a sign that, you know, rates are not as deleterious as we think, and they can go even higher. But nevertheless, I think as we move into 23, we're going to start the year with a coupon. We're going to start the year with an interest rate. So if prices go down, you've got a cushion now. You've got an interest rate that we haven't seen in 15 years.
But does it mean, you know, you go back to 1918 and everything that happened there earlier in the year, folks, we did the collapse of Russia off the war in Ukraine and what it did to J.P. Morgan. It was really something. Let's drag it forward, Jim, to 1974, and we were greeted in 75 with up, up, up. Can stocks stun this year and do a 75 or a 1982?
Sure, and they need one thing to do that. They need signs that inflation is, after all, transitory. It is on its way back to 2% without a recession, that's its natural long-run rate, and it's going to stay there. If you see something like that, the Fed can settle down, the market can take off then at that point. But if inflation is not on its way to 2%, the market will struggle. I've argued that inflation in the post-pandemic era, inflation is this story, is the game, and it will continue to be. And whether or not it goes back to 2%, on its own naturally in 2023, 2024.
If inflation's the story, as everyone is saying that it is, how important is today's read, the last inflation read that we get of 2022, as we get a sense of where the consumer is ending the year?
I think we're going to get PCE, and the Fed is focused on core PCE, and they've made, Chairman Powell's made the case that neutral is getting the interest rates, all interest rates, sustainably above core PCE's rate, which should be around 4.5 or 4.6 when we get the number. Well, now all of a sudden that puts that interest rate or interest rates within that possibility of getting above the inflation rate, something they haven't been this whole cycle. So if we see that 4.5, 4.6, and we see it trending lower, we could be getting a lot closer to at least neutral, according to the Fed.
Jim Bianco, thank you so much. From Chicago, stay warm. Mr. Bianco, Bianco Research, providing weather forecasts for Bloomberg Surveillance.